Howdy, Jacob here. Today we're looking at CNXN in the electronic equipment, instruments, and components industry. They provide various IT solutions worldwide, headquartered in New Hampshire, founded in 1982. Growth of the business is very lackluster. Just under 2.5 billion in 2014 in revenue to 2.85 billion in 2023, declining 8% over the last year. We are still above their pre-COVID levels, but still not substantial, with gross margin very low, operating margin also very low, but always positive for the last 10 years at least, and pretty consistent as well. The gross margin side is increasing pretty substantially. The operating margin side, pretty consistent around the 3 to 4% range. They did start to pay a dividend, and it's a 0.5% yield. So nothing substantial, especially in relation to the earnings per share. Low payout. Great return on invested capital, solid return on assets. Hopefully they're reinvesting back in themselves to get these types of rates of return. That'd be very impressive. Balance sheet shows about 300 million cash-like products with no short-term, no long-term debt. So very comfortable with that balance sheet. That's a safe investment from that standpoint. And on the free cash flow side, also no negative years of free cash flow. Love that. Use of cash, 9 million on the dividend side. They had immense free cash flow, rolling 12 in last year. Even before that, nowhere near as much, but maybe averaging 30 to 40 million. So if they can keep this up, what they're doing right now, these margins, that'd be extraordinarily impressive. They don't have any R&D going on, but just nice production. Earnings, like I said, a bit more consistent, but that free cash flow figure, $188 million for a 1.8 billion market cap, is 10 times their free cash flow. So if they're able to keep that up, that could be impressive. All right, so assumptions on the revenue growth side, it doesn't look like the last 10 years have been crazy sexy for them. I'll say 4%. What was their use of cash? Mostly reinvestments recently, a little bit of share repurchases, a little bit of dividend. Haven't made an acquisition since 2016. So through that reinvestment, I think maybe they could even get 5%. And then the net income margins, I don't think they're going to be crazy high here. Maybe let's do 2.5 and 3 with a share change of, they'll just offset stock-based compensation, I feel like. Terminal PE, I'll just go market average here with a 15% return. Dividend, it's new, so I don't know whether they're going to increase it or not. So I guess it doesn't say it's new over here, but I'm fine keeping that the same. So with my assumptions currently, the company's stock price needs to fall 65% before, before you get the return right here, and before I'd probably do a deeper dive. And so for me currently, I'll just be waiting it out, reviewing other companies in the meantime. Hope you enjoy the video and have a great rest of your day. Thank you.